Hi, good morning, everyone. Thanks for joining us for our morning call. It's 11:15, so I guess we'll start. I'll hand over to you, Paul.
Okay, so thanks, Glenn. For today, we will be just running through a summary of the presentation we did on Saturday, which is our 2022 equity strategy. We will just run through the sector stock picks, and Viren will close it with the technical charts. Next slide. Next slide. Okay, I'll hand it over to you. We'll start off with the sector, Glenn.
Yes, thanks, Paul. So we'll start off with the banks. So we'll do the 2021 review. So for 2021, the banks did very well, and this was due to the bounce back in earnings. And earnings are now back to the pre-pandemic levels, as you can see from the chart. So the improving credit environment and lower NPA formation has allowed the three banks to write back GPs, and this has resulted in higher than expected earnings, 4% higher than our forecast. However, as interest rates remains low, the bank's NIM have also remained low at about 1.5% as at the third quarter 2021. Nonetheless, these lower NIMs were offset by higher loan and deposit volumes and higher fee and other non-interest income as the economy slowly recovers. So for dividends, all three local banks have also reverted to their pre-pandemic DPS payouts after MAS lifted the restrictions. Lastly, the bank's loans under moratorium remain relatively unchanged, with DBS the lowest at 0.5%, OCBC at 2%, and UOB at 4.8% of total loans. However, for OCBC and UOB, there was concern surrounding the Malaysian government's announcement of a blanket 6-month moratorium until early 2022, which might cause a slight uptick in Malaysian relief loans and NPLs. Nonetheless, the impact of the interest waiver scheme in Malaysia would be marginal, and non-performing loans under moratorium are expected to drop with the improving economic situation. For our 2022 outlook, interest rates have inched up from their 6-year lows, but we expect rate hikes only in the second half of 2022, and the market expectations are for 3 rate hikes by the Federal Reserves. A 25 basis point move can raise earnings by 7%. As you can see from the chart here, the NIM guidance, the NIM has remained low for all three banks, and the guidance are to remain low and at its current levels. However, this low NIM would be offset by high single-digit loans growth and higher fee and commission income as investment and trade activities pick up. Improving economic conditions and rising interest rates could improve NIMs for the banking sector. The NIM improvement is only expected in the later part of 2022 as asset quality is expected to stabilize, and the banks expect to continue to see strong demand for loans as cross-border activities pick up. For their exposure to China, it remains contained, with all three local banks' exposure to China small, at less than 11% of total exposure. A majority of these customers include mainly domestic and policy banks, top-tier SOEs, large local corporates, and foreign investment enterprises. The bank's exposure to corporate real estate loans in China remains minimal. We remain overweight on the banking sector. With an economic recovery underway and earnings starting to return to pre-pandemic levels, we expect this to continue into 2022. Also, with total allowance coverage being over 30% above the MAS regulatory limit, we believe there is further room for GP reversions in 2022, which would boost earnings. The bank's dividend yields are attractive with upside surprise due to excess capital ratios. Furthermore, improving economic conditions and rising interest rates remain tailwinds for the banking sector. So that's all I have for the banks. Now I'll send it over to Natalie. Natalie, over to you. Natalie, I think you're on mute.
Good morning, everyone. Good morning, everyone. Okay, moving on to the property sector. Um, 2021 was a headline year for the property market. Sorry, give me a minute. 2021 was a blockbuster year for the property market. According to URA's flash estimate for 4Q21, the private residential index rose to 174 points, forming new highs for the fourth consecutive quarter. And this is up 10.6% year on year for the full year. However, if you look at a longer time period, over the last 10 years, prices have grown at a CAGR of 1.2%, up 7% from the high in 2013. Next slide, please. In the chart on the left-hand side, new and resale transactions, including EC units, increased by 43% and 87% year-on-year respectively. New home sales, excluding ECs, came in at 12.8 thousand units, surpassing our 2021 forecast of 11 to 12,000 units, buoyed by the low interest rates and higher equity values from robust resale prices. Construction delays and grants for first-time homeowners lifted the resale market, and this cumulated in some 21,000 units changing hands, the highest in 11 years. In the chart on the right-hand side, we see the unsold inventory has declined about 30% since the start of the year, from 24,000 units to about 17,000 units as at third quarter of 2021. We see the least risk for the OCR, which stands for outside central region segment, due to limited supply and strong upgraded demand, as these properties are used as residences instead of for investment purposes. There were two cooling measures announced in 2021, the raising of the development charge in September and the raising of the ABSD in December. In terms of outlook, the government has been raising the supply of residential units to cope with demand. The number of units on the GLS confirmed list was raised twice in 2021. As for the number of units in the first half 2022 GLS confirmed list, this was increased by 39% or 785 units, forming 43% of the total GLS units compared with 20% on the confirmed list over the last 2 years. We think that the new home sales may fall between 0 to 20% in 2022, coming in between 10 to 12,000 units, as the higher ABSDs and record high prices may result in a wait and see approach for upgraders and property investors, while home prices could rise by 0 to 5%. The risk of additional cooling measures should remain low if residential prices keep pace with FY22 GPT growth forecast of 3 to 5%, in our view. We remain overweight on the property sector as developer valuations are undemanding, trading at 40 to 50% discount to RNAV. Next slide, please. On to the REIT sector. REITs experienced an early share price recovery in June 2020, but prices have been trading sideways from there. Further reopening and return to office will lift retail, hospitality, and commercial counters. DPU yield spread is at 2.6%, and this is the dark blue line seen in the graph below, and is currently at the negative 1.2 standard deviation level. Forward DPU yield is expected to be at 3.5%, close to the average DPU yield spread. We think that REITs are relatively fair value, and we are overweight on the REIT sector as we expect DPU growth from recovery, acquisition, and AEIs to exceed interest rate growth. Interest rates, although rising, are 2 to 3 times below the 5 and 10-year averages and will remain below historical levels in 2022. This has supported some 13 billion worth of acquisition made by the REITs in 2021. We are forecasting an average FY22 DPU growth of 11% for REITs under our coverage. Moving on to the retail sector. In the chart on the left-hand side, we see that the rental index is still on a downward trajectory. However, landlords have reported positive reversions for some suburban leases, while reversions for downtown malls have narrowed from negative mid-teens to negative low teens. Tenant sentiment has improved, resulting in a 1.5 percentage point year-on-year improvement in occupancy. The rebound in occupancy is a leading indicator for rental recovery. There was strong leasing demand from F&B operators and from both expansion and new-to-market brands, as well as some local fashion and lifestyle brands adopting an omni-channel strategy. So they are setting up or expanding their brick-and-mortar presence. In the chart on the right-hand side, the retail sales value has been tracking 2019 levels closely, between negative 1.6% to negative 13%. The tightest was in October, where the RSV was at negative 1.6%. RSV could exceed 2019 levels as Singapore entered its transition phase in November. We are overweight on the retail sector as we see green shoots forming. As Singapore returns to normalcy, larger group sizes for gatherings and events and return to office should increase purchasing triggers and dining out, lifting tenant sales. The return of HM sales could also lift revenue by about 5%, while the return of international tourists should benefit downtown malls. Moving on to the office subsector. In the graph on the left-hand side, we see that rents are moderating, but occupancy is still on a downtrend. Thankfully, Office S-REITs own Grade A CBD assets, which have been experiencing a flight to quality. Despite hybrid working arrangements, some companies, while rationalizing their are opportunistically upgrading their corporate address while rationalizing their space needs in this tenant-favorable environment. Technology, finance, services, excluding banks, and real estate consultancy companies were the main drivers of demand. We are neutral on the office market as we think that the office market still needs some time to absorb the slightly elevated vacancy. The 4-year average supply of 0.8 million square feet is on par with historical 5-year supply levels, although front-loaded in the initial 3 years. Moving on to the industrial subsector. In the chart on the left-hand side, we see that industrial was the only sector that showed both rent and occupancy growth. Occupancy uptick at factories and warehouses helped to offset occupancy decline in business parks due to downsizing from office users. Demand came from new economy sectors such as biomedical, e-commerce, as well as manufacturing and engineering sectors who are moving from JIT, just-in-time inventory, to just-in-case inventory management to deal with supply chain bottlenecks. In the chart on the right-hand side, economic data looks positive. The Purchasers Manufacturing Index is in its 17th consecutive month of expansion, while rents appear to have bottomed out. However, leasing demand may remain muted as most companies remain cautious with their business expansion plans. Competition remains stiff, especially for factory assets, which is faced with considerable supply in FY22. Business park occupancy lags industrial asset classes at 84.3%. However, recent demand from biomedical sciences and information and communication technologies should help shore up occupancy. Moving on to the hospitality sector. The vaccinated travel lanes kicked off in September of 2021, and since then we see a pickup in both international visitor arrivals, IVA for short, and outbound resident departures by air. Historically, IVA was double the resident departures. However, since the pandemic, outbound departures have surpassed IVAs. So in the month of November, IVA jumped by 71.6% month on month. However, that only represents about 2.6% of 2019 average IVA. Similarly, domestic departures by air jumped by about 65% month on month, forming 10.4% of 2019 average. In the graph on the left-hand side, we see that RevPAR showed a strong uptick, about 59% growth year on year, in November of 2021. And this was supported by higher international visitor arrivals, staycation demand, as well as the isolation business from the government. Occupancy for November was at 76%, and this compares to 55% a year ago, while room rates have improved by about 15% year on year. In terms of outlook, we think that governments will continue to push for the reopening of borders, layering on additional testing and isolation requirements and temporary bans as and when new variants of the virus emerge, instead of shuttering borders. Leisure travel should gain some traction as more prospective travelers accept the risk of changing VTL requirements. Recovery to pre-pandemic levels is likely to occur in 2024, and we are neutral on the hospitality sector with Ascott Residence Trust as our top pick. Now I'll hand the time over to Paul.
Thanks, Natalie. So we on the tech sector, on semiconductors. I guess if you look at the longer term trend, the shaded area, you can see that semiconductors has been a really structurally has been really strong. I think you can see that. Let's say 2011, you pick the 300 billion of sales, and after 10 years, it's doubling. So this has been a structural growth story over the last 15 years. Of course, there are cycles in this, and what we did was we just wanted to know how much longer can the semicon upcycle. Upcycle, we just use year-on-year growth. Again, there's no science to this. I mean, but if you look at the growth, it typically averages about around 2 years where you see consecutive months of growth. Right now, we're already touching those levels. The longest over the last 15 years has been about maybe 2.5 years. So what we think is that the cycle could stretch into the first half before we could see some deceleration. But having said, I mean, if you look at the shaded areas, you know that this is semiconductors has been it's a boom. I mean, it's like structurally has continued to grow. Every 10 years, it basically doubles to almost 600 billion in sales. And the other thing that we noticed was that because of the supply constraints, even some of the smaller semiconductor names like that's listed on SGX, at least like GVT or even JEP, they're getting more traction because the semiconductor companies are looking for more and more suppliers. So they're even reaching out to some of the smaller companies to be part of the vendor list or APL. Sorry, AVL. Sorry. Next slide. For telcos, we shared this many times, but let me just rephrase it again. So this is basically the selling price for phones. I mean, basically how much they bill us every month. So you can see that in 2009 onwards, when 3G was still around, when everyone had international calls, we had to do IDD, there was still SMS. But once we hit 4G, and because of the competition of TPG, you can see that prices almost half, I mean, roughly speaking, from 70 to 35. And that's when the whole telco sector got derated, because they lost IDD revenue, they lost SMS revenue, and then they had competition. I think things were stabilizing. Then we had of course, pandemic happened. Then they lost the roaming revenue, to $40, then dropped to 30, which is like all-time low in terms of prices. And as you know, prices once it drop, it falls straight down to the bottom line. So for us, we are neutral right now. It's basically just waiting for borders to reopen. Roaming revenue is 20% of revenue. We think it could be as much as 25 to 30% of profit because it's a very high margin business. There's virtually no incremental cost. When a customer from Singapore go to Malaysia and roam, virtually nothing. They just have this cross-border arrangements. So for us, it's neutral, but it is an interesting sector for us because, like for StarHub, they still give you quite nice yields, about 4%. And you just like we mentioned before, you just wait for the borders to reopen. For Singtel, it's all about India, turning around India, because I think 40% of the valuations come from just the mark-to-market of India. Next slide. This is government. This is healthcare. We are essentially referring to hospitals when we talk about this chart. So this, when the pandemic happened, the most of the private hospitals lost 20% of their revenue because of the loss of the medical tourism. So you got an initial sell down, but as the pandemic reached, I mean, especially for this year when the government started to vaccinate and started to do more PCR tests, and you can see from here the spike in government spending. Actually, we calculated wrongly. It's not 9 billion, it's 7 billion. So this is operating expenditure. So this is not like the government is building a new hospital. This is just daily bills, you can say, that daily cost to just for healthcare spend in Singapore. So a lot of it comes from COVID-19 PCR tests, COVID-19 vaccination. If you listen to Parkway, I think third quarter alone, almost 30% of their revenue in Singapore comes from government related. Raffles doesn't disclose, but I guess it's more or less the same. So because of this, the hospitals have done well. So the issue right now is, as we move into 2022, hopefully when it's more endemic and when there's less need for PCR tests, and it's just how are they going to transition when they lose this so-called almost 30% or 20 to 30% of revenue, can they transition to medical? So we're a bit more cautious because we worry that although our overweights are not on Q&M and so forth, we are a bit more cautious for hospitals because they still need to do this transition when government slows down on the spend, and then they have to, it has to be catch up or made up by medical tourism. The next slide. For this is ASEAN consumer. So this chart is basically retail sales for some of the key ASEAN countries. I mean, I didn't put Singapore because we do it separately. But you can see that pre-pandemic in 2019, no, Jan 19, if you look at the chart, the retail sales was reasonably strong. It was maybe double digit, 11, 12% for some countries. Then when you look at the April 20, you can see that sales completely collapsed because of the pandemic. Then it started to recover. You get this big spike in February because of the festive period and also year on year because of the collapse. But the worst hit was last year in June when pandemic was spread widely, especially in Indonesia, Thailand, and Vietnam, and of course even in Malaysia. So all these countries were hit. Initially, the recovery was they still recovered because the economic conditions were still better, so it was more a shutdown. But then as it drags on, consumer sentiment was affected. Consumer incomes were affected in ASEAN. So that's why you can see this collapse in 2021 onwards. It's all more or less like negative sales. But we think 2022 would be better. And ASEAN consumer sales is really just talking about two stocks. Is Dairy Farm and Dairy Farm and Thai Beverage. I guess to a certain extent, even Jaffar, because of Indonesia. But we think 2022 could be a better year purely because of the base effect. Because last year you had so many lockdowns. And then so this year, hopefully there are no lockdowns. So year on year, you get this big improvement in retail sales, number one. And hopefully with the fewer lockdowns, consumer sentiment will improve and consumer income levels will improve. So Dairy Farm, like after 2 years of, I think they were down the worst performer for 2 years. So there is some angle, I guess, if you're looking at a weaker base year and a rebound as lockdowns ease. Next slide. We'll just move on to our stock picks. Next slide. So this is our usual model portfolio. We only kind of change any stocks every quarter. So if you look at this, for this quarter, we took out Thai Bev and we added in Del Monte, which Vivian will explain, but mainly because of the higher growth profile for Del Monte, and also because of the cheaper valuations. I think they're only like 8, 9 times PE compared to Thai Beverage, which is already, I think, probably 16, 17 times PE. Next slide. This is just for illustration. This was the performance. Again, the way this portfolio design is every month end, I mean, theoretically, is all balanced. So every stock has a 10 percentage points. So if you look at the table on the right, we were below the STI, and that's because we were hit very badly in the first quarter. I think Yoma was down 50% in the first quarter 21. Of course, we could have taken it and what, but we didn't. We just wanted to be consistent and only make changes only in end quarter. What did well for us, at least for 2021, was Propnex and CapitaLand. The chart on the left is just for illustration. It's just the last 3 years now. How did this portfolio move compared to the STI? Purely for illustration. Next slide. Hand it over to you, Glenn.
Yes, thanks, Paul. So I'll touch upon DBS. So from this chart, we can see that the interest rates have linked very closely to the NIMs. And DBS has mentioned that a 10 basis points rise in interest rates could raise their PBT by about 180 to 200 million. This is indicating a 2.7 increase in earnings per 10 basis points. In the most ideal situation, 3 rate hikes totaling 100 basis points would mean a 27% increase in earnings. So repayment by weaker exposures and credit upgrades has allowed DBS to write back GPs totaling 413 million during the year, while specific allowances fell 59% year-on-year to 68 million. And this was due to a write-back for a non-performing loan. It also lowered full-year allowances to under 100 million, with credit costs likely to be under 20 basis points. We believe full-year allowances will come under this guidance because of the group's asset quality. For their fees, all of their fees rose by 90 million or 11% from a year ago. Their wealth management fees rose 16%, transaction fees grew 18%, and card fees rose 13%. DBS continues to attract net new money inflows from mid to ultra high net worth individuals, as well as from the region. The consistent momentum in their wealth management segment will support a more stable income base. For their loans under moratorium, as mentioned earlier, it remains low at 0.5% of total loans, and this is the lowest among all three local banks, with no exposure to the rest of ASEAN. SME and mortgage loans under moratorium in Singapore are down to around 100 million with no delinquencies. 80% of their ESG loans in Singapore are paying both interest and principal, with no pickup in delinquencies as well. The group also has no exposure to real estate loans in mainland China. With its capital position and liquidity well above regulatory requirements and high allowance reserves, we believe that DBS has sufficient provisions to ride out the current economic uncertainties. The third quarter 21 DPS is 33 cents, back to the pre-pandemic levels, and we do not rule out special dividends. We maintain and accumulate with an unchanged TP of 35.90. Now for UOB. UOB's profit should recover in 2022 on the back of stabilizing margins, stronger fees, and lower provisions. From the table, we can see that the fee income has been stable, and we expect wealth management, loan-related, and card fees to expand 22% year-on-year. We continue to expect credit costs to come in below the guidance of 25 basis points. There is earnings upside from the write-backs of the $1 billion in management overlay of general provisions. General provisions is expected to trend at around 80 to 90 basis points of gross loans, and this implies around 450 million of write-backs. A condition to the write-back would be the outlook of the pandemic and UOB's loans under moratorium, especially those in Malaysia. With the Malaysian government's announcement of a blanket 6-month moratorium until early 2022, the management expects an increase in NPLs among consumers and SMEs in Malaysia, with management expecting an uptick in the NPL ratio to about 1.7 to 1.8%. Around 20% of Malaysian loans under loan relief, or around 7 billion. And management has estimated the impact of the interest waiver scheme in Malaysia to be marginal at less than 10 million. For their NIMs, the management only expects improvements in NIMs in the later part of 2022. Asset quality is expected to stabilize, and management expects to continue to see strong demand for loans as cross-border activities pick up. The ASEAN loans growth are expected to be higher, with some slowdown in Singapore and North Asia. Growth so far has been skewed towards the developed markets, as the Asian economy remains muted. But the management expects this to change in 2022 as the economy recovers. I'll now briefly touch upon the UOB's acquisition of Citi. So UOB recently acquired Citigroup's consumer banking franchise in Indonesia, Malaysia, Thailand, and Vietnam for about 4.915 billion. And this was paid in cash and is fully funded by UOB's excess capital. So Citigroup's business net asset value as at deal completion was about 4 billion. So there was a 915 million premium paid. This deal includes 2.4 million retail customers as of June 2021, and Citigroup's 5,000 employees, including senior management in the 4 countries mentioned. So post-purchase, UOB CET1 will drop by 70 basis points to 12.8% from 13.5% as reported in the third quarter 2021. The completion is expected between mid-2022 and early 2024. They also have mentioned that there's an immediate $1 billion in incremental annual income uplift. So for the positives, the biggest positive would be that they would gain scale in the 4 regional markets. So with this purchase of Citigroup's consumer banking franchise, UOB is able to accelerate its growth by 5 years, as mentioned by their chairman in these 4 countries, where UOB already has a significant presence in. UOB's management has also mentioned that it expects some slowdown in Singapore and North Asia. So this acquisition will position them to further grow their ASEAN presence. Also, the acquisition is immediately accretive to UOB's EPS and ROE if we exclude the one-off transaction costs, which will be mainly incurred over the first 2 years. However, if these costs are to be included, the group will be EPS and ROE accretive by 2023. UOB has also targeted a higher ROE of more than 13% and ROA of about 2% by 2026 with this acquisition. Lastly, for the positives, with this purchase, UOB CET1 ratio has dropped by 70 basis points, as mentioned earlier. Nonetheless, UOB has mentioned that it is comfortable with maintaining the current dividend policy of a 50% dividend payout ratio. For the negatives, there's one negative, and that is the acquisition consists of one-off costs amounting to around 700 million. And this includes a cost of 200 million in tax and stamp duties, as well as expenses for integration and branding. Nonetheless, including this cost, UOB expects to be EPS and ROE accretive by 2023. As such, we maintain and accumulate with a higher target price of $31.30 from $29. So that's all I have for the banks. I'll now hand over to Natalie.
Thank you, Glenn. Good morning, everyone, again. So now moving on to Ascott Residence for our stock picks. So we like, first of all, Ascott is a hospitality REIT, and its portfolio consists of service residences, hotels and business hotels, rental housing, as well as student accommodation. So the first reason why we like Ascott is due to its high exposure to domestic demand, which as evident from the recent pandemic, is more resilient as compared to international demand. So 70% of the service residences are located in markets where there is a large domestic leisure demand, such as France, Spain, UK, US, Japan, and Australia. Demand for the US student accommodation, as well as the Japan rental housing assets, this is largely domestic demand, more than 90%. Which, yeah. In terms of our second investment merit, we like Ascott due to its long average length of stay. So the average length of stay for corporates at the service residences ranges between 3 to 6 months to a year, and this includes demand from project group, short-term assignments, and secondments. Okay. And for the for the extended stay segment, which comprises the rental housing properties as well as the student accommodation assets, occupancy for this segment is high, above 90%, even during the pandemic. And the average length of stay ranges between 1 to 2 years. So apart from high income visibility, these well-located extended stay assets have delivered rental growth during the pandemic years. The third reason why we like Ascott is we expect it to benefit from the recovery of international tourism. Yeah, so that will also help while the stable revenues from the current demand from the local market, as well as the long stays, that will provide a base while recovery kicks in, but that's not to downplay the recovery on its own. Okay, so we have an accumulated rating on Ascott with a target price of $1.19. Moving on to the second stock pick, which is Fraser Centrepoint Trust. So Fraser Centrepoint Trust owns a portfolio of dominant suburban malls located near household catchments and transportation nodes. So the first reason why we like FCT is due to its resilient suburban malls, which have a high proportion of tenants in the essential services sector. So this is the pie chart on the right-hand side. So essential services accounts for about 54% of gross rental income. And the resilience of necessity-driven spending is seen from the sustained above RSI tenant sales achieved in 12 out of 18 months during the pandemic. And this is the graph on the left-hand side. The second reason why we like FCT is because suburban malls are defying weak retail outlook. So FCT is starting to see positive reversions for some of the leases signed, and this, of course, is an outperformance when you look at the downtown malls, which are still registering negative rental reversions. The third reason why we like FCT is due to the organic growth from the increased household catchment size in the areas surrounding 3 of its largest malls. So this will not only bring a higher shopper footfall, but also will help with the lifting of tenant sales. Lastly, I would like to mention that as the economy reopens, the return of atrium sales should also help to lift earnings by about 5%. Overall, we have a buy rating on FCT with a target price of $2.83. Now, moving on to the last stock pick for me, that is CDL. Okay, so we like CDL because first of all, it is catching the property upcycle with a strong development pipeline. So they have currently about 1,500 units in their pipeline that has not been sold. And this year, if you look at the bar on the red color bars, that is the number of units sold as well as the sales value for 9 months ended 2021. So the full year data is not out yet, but on a 9-month basis, this has surpassed how they have performed in 2020. Okay. So meaning to say that they have been able to capture, better pricing due to the increase in private private prices. Inventory risk is low in our view, as 24% of the units are ECs and 28% are mass market condominiums, which are located in the OCR. And this is the segment that has enjoyed strong sales. Of the remaining 43% of units located in the central region, 35% of units are from 2 redevelopment projects, which have higher margins owing to below market land cost. Okay. Second of all is the impending recovery of the hospitality sector. So CDL's hotel segment contributes about 16% towards EBITDA in 2018 and 2019. Okay, so we are expecting the hospitality sector or rather the hotel segment to recover gradually over 2022 to 2024 before reaching back to pre-pandemic levels in 2025. Last of all, the CDL's asset monetization and building up of fund management segment. So CDL is in the process of listing a UK commercial S-REIT, of which it will be the co-sponsor of. It intends to inject 2 UK office assets into the REIT. And this will actually unlock about 500 to 600 million in capital for the group. And the listing of the REIT will, of course, contribute towards CDL's fund under management target of $5 billion. CDL is now still trading at an attractive 51% discount to our RNAV. And we have a buy call on CDL with a target price of $9.19. That's all for me. I'll now hand the time over to Vivian.
Thanks, Natalie. So the first topic for me would be LHN, which is a real estate management services group. LHN is now capitalizing on the 2 hottest trends in the real estate market, offering flexible, affordable, and adaptable spaces. So the first trend that we'll be covering, you can refer to the left side, would be the rise in e-commerce, which has led to higher demand from online business owners for spaces. So they offer these work plus store outlets, mainly self-storage spaces, 70% occupied by e-commerce tenants, and they are seeing full occupancy at these spaces. If you were to start a business selling goods on Shopee or Lazada, then renting a unit in the picture on the top left would be the cheapest option for you, with flexible lease terms and also competitive rates that also include utilities. They also offer delivery services for you to deliver the goods to your customers, car sharing services to make it more convenient for traveling, and also EV charging facilities if you need to charge your electric vehicle. For Work Plus Store, we are expecting an addition of another 1,000 units. Currently, there are about 1,500 units under operations. So this would represent growth at a CAGR of 34% from FY19. The second hot trend would be co-living on the right, which has accelerated due to the pandemic, similar to the e-commerce trend. And for LHN, they offer co-living spaces under their Coliu brand. So due to the prolonged work from home trend, more millennials or young working professionals are preferring their own living spaces. And similarly, they are also seeing full occupancy and offer flexible lease terms. For FY22 and 23, we are expecting about a total of 600 keys to be added, and this would represent a growth at a CAGR of 44% from FY19. The final point would be the growth in the number of car park lots under management by 43% to somewhere around 20,000 lots with the acquisition of the 33 JTC car parks in November 2020. And this segment is currently the most profitable segment. With the increase in number of EV charging facilities that they are planning to add to the car park lots under their management, then that would also be an additional income stream for them. So we have a buy rating with a target price of 54 cents. Moving on to my next counter, which would be Del Monte Pacific. So for Del Monte, they have two main subsidiaries. Firstly, Del Monte Foods, or DMFI, which is the US subsidiary, and Del Monte Philippines. For Del Monte Foods, it is a new chapter as they turn the page of restructuring over. So referring to the graph, you can see that since the acquisition in 2014, they first turned profitable in FY21. This was achieved through the focus on the higher margin branded retail business, the emphasis of the low margin non-branded channels, and introduction of new products that contribute about 5% to the total revenue. From FY18 to FY20, you can also see that due to the fact that they were closing the loss-making factories, they had to incur this huge amounts of one-off expenses, which resulted in the net losses. And more updates would be for first half of 22. You can also see that the net profit has increased tremendously, with the net profit almost double that of FY21. And we are forecasting an increase of 39% in net profit for FY22. Comparing the October to April 2021 prices, there has also been an increase of about 10%. And even with that, they have managed to maintain their market leader positions, with the market shares even increasing in some categories as more consumers are turning to trusted brands like Del Monte for better quality meal preparation options. The second subsidiary, which is also the most profitable, would be Del Monte Philippines. And for DMPI, we are expecting stable growth as Del Monte Philippines holds dominant market shares in the Philippines of up to 91% in key categories, including packaged pineapples and tomato sauces. So for Del Monte, they are currently trading at about 8 times PE, and we value the company at around 13 times PE, which is about a 20% discount to the industry average of about 16 times due to their high debt levels. So moving on to the last counter for me, which would be Coda. Coda is a furniture manufacturer for the living, dining, and bedroom. They have manufacturing facilities in Vietnam and Malaysia, and production has since resumed at full force since the operations were disrupted due to the lockdowns in the second half of 2021. So you can refer to the chart. In the chart, the dark blue bars are the 12-month moving average value of Vietnam furniture exports, which has been recovering since the end of 2021. The red line represents the 3-month moving average year-on-year change. So for the recent few months, you can see that there is growth, but it's still quite weak, mainly due to the fact that the operations were affected, I think countrywide due to the lockdowns in second half of 2021. But month on month, the growth is quite strong. So Vietnam furniture exports have been growing about 30% for the last 3 months of 2021. So this is on the supply side. On the demand side, Coda continues to ride on higher demand for furniture, with the prolonged work from home and also study from home trend, resulting in higher demand globally for changing or purchasing new furniture. On the retail side of the business for Commune, as of December 2021 last month, there are 79 stores in China, and they target to have 100 retail stores in China by the end of the year. And lastly, for Coda, they are also venturing into manufacturing sofas, so that would be an additional income stream. We have a buy rating with a target price of $1.10. So that's all for me. I'll now be passing the time back to Paul.
Thanks, Vivian. So next one will be ComfortDelGro. Hopefully, it was also one of our key picks last year. hopefully nobody noticed that it was the second worst performer of the STI, was down 16%. Nevertheless, we still like it. There are basically three reasons why we like it. Firstly, even though they were in the middle, in probably one of the worst hit in the pandemic, but actually their balance sheet actually improved. This is unlike the other transport sector, especially aviation. So pre-pandemic, their net cash was probably 70 million. Then now it's jumped to almost 450 million in net cash. The reason is because they've been able to cut capex, and this is now a very high depreciation, high fixed cost business. So that's why they still managed to be cash flow positive. So that's number one. So we like it when the company, if they exits the pandemic and the recovery, hopefully the recovery happens, their balance sheet hasn't been negative impacted. Secondly is that we like the operating leverage. If you look at this chart, so far you don't really see the recovery. If you look at this chart, so far it's only the blue line, which is retail that has recovered. So this is a Google mobility chart. It measures like how many people go to office. I mean, basically they're tracking all of us. I mean, those who have an Android phone. So the green line is office, and the red line is those who use public transport. So what our thesis is that this will improve. We think work from as social restrictions get removed or eased, we think that the green line will improve and the red line will improve, and this will benefit the volume for Comfort. And this is a very high operating leverage because not every incremental passenger, especially on the train, it will just flow down to the bottom line. The second operating leverage they will get is from the taxi rebates. Because of the lockdowns and so forth, they've been giving taxi rebates 20 to 50% of the daily rental. The daily rental maybe 120, so they only collect $60. The other 60 just give them. So we think as the rebates are removed, I think now it's down to around 15%. As these rebates continue to get lower or eventually removed, you will get this big, huge jump in earnings because of the operating leverage as everything goes down to the bottom line. And the third reason is basically it's like 40% below pre-pandemic levels in terms of the share price. This stock we always get a lot of questions like why in the world are we still recommending this? But anyway, these are the three reasons. Next slide. The other one is HRNet. So for HRNet, what we think, at least for 21 and 2022, will be a record year for them. I think so far in the first half, I mean, if you exclude the one-offs, they're probably the earnings was up about 40-50%. So we think this year it will be a record year because of volume will be up, pricing will be up, and I mean, it's a record profit. So reason why volume is up because of the huge demand for the workforce right now. 2020 was an unusual year. There wasn't much movement in the workforce. So 2021, I think most companies are going to see a huge employee churn because a bit of pent-up in 2020. So that's number one. Number two is the price. Because right now the wages are up because of the shortage of workers and so forth. So on this chart, you can see the vacancy rates is all-time high, the blue line for the workforce in Singapore. And the vacancy to unemployed, every two jobs every 2 jobs out there that's vacant, there's only one person that's unemployed that can fill it. Of course, this could be mismatched. This could be meshed with the foreign workforce. But if you want to look at more salaried, more services, then you look at the PMAT chart. You can also see that the vacancies are at the all-time high. So this will be more because the HRNet has two parts of the business. There's the flexible. They benefited like social ambassador. Permanent is more the permanent hires are managerial level. So the permanent business will benefit from the improvement in the red line. Next slide. Okay, this is my last one. So for us, we also have a buy on Q&M. Our buy is not because of the PCR test, which is nice, but in terms of a target price, the Acumen, which does the PCR, is only 3 cents to our target price of 82. I just did a double check. The bulk of our target price actually comes from the dental business. So most important for us is the core dental needs to improve. And you can see from this chart, they hardly grew the dental because I think they just wanted to do acquisition. And during that period, 2016, 2017, they were very heavy, investing a lot of the time in China. But in 2019, they started to ramp up the clinics because they realized 10% market share. There's still a lot more market share that they can capture. So 2019, they ramped up to the fastest by 10 plus clinics. But of course, the pandemic happened. But this year, 2021, I mean last year, we think they can probably ramp up another 20 clinics, giving them at least like a 20% growth year on year for 2021 and 2022. I think they can I think the ultimate plan is maybe eventually to even double the number of clinics. But we need to monitor if it actually happens. But our whole story is basically all about their dental franchise. The PCR is good, and they're probably going to give very attractive dividends based on the PCR earnings. I think the yield now is about 5 or 6%. Yep. Okay. Next slide. I think that comes to our conclusion. Okay, we'll hand it over to Wei Ren for the technicals.
Yep, thanks, Paul. So give me a moment. Hey, Glenn, where's the slide now?
Hold on, I think you skipped past it. Let me share it again.
So sorry. Yeah.
Okay, is this the one, correct?
Yep, thanks, Glenn. Just basically, I just go through the STI, just go through. So basically, it's just what I have mentioned on the strategy and stock pick. We expect some sort of like STI. Ever since now, STI has really broken the 3002 psychological resistance level. Currently, I think price is still on a longer term front. Wave D is still unknown. So target of 3004 is likely possible by within this quarter itself, or even the next quarter. But I think on the longer term front, Wave D at 3007 is still unknown. So in order to confirm the impulse at Wave C, whether is it the start of a 5-wave impulse wave or a corrective wave, really has to depends on whether 3004 is really being broken and then subsequently 3007 on. All right, so on the next slide, on the weekly chart. Next slide, please. I do not have the control. Thanks.
Yeah, it's showing the weekly chart already, Wei.
Okay, I think it's some sort of lag over here, but I don't know. Zoom recently got this problem as well. Yeah, I think Zoom has this problem. So sorry, guys.
Whether we can see the weekly chart.
Okay, never mind. It's okay. So I just use my slides. So from the weekly chart, I think you can see that there's high, low, and then the panel has broken out. Price rebounded from support zone 1 from 3000, and then price has really been broken up to the resistance zone 1. So and then right now we are targeting resistance zone 2, which is what I mentioned about the 3004 region. So in this case, yep, I foresee that price is likely to go into 3004. Okay, so with that, I conclude my sharing on the STI. Right now, I just go on to the what do you call it? The Q&A. So just take note that not all Q&A are reviewed through. Not all Q&A will be not all the counters that you have requested will be answered, because some of them I look through. Now some of them do not provide a signal. Some of them are range bound. Some of them, like I said, don't bother looking at it. Just let go. Okay, so let's look at the banks. I'll share about OCBC. OCBC actually is really kind of like confirming a bullish upside. First of all, you can see that the rebound from the $11.11 was like kind of like confirmed, and then it concludes on what I shared earlier on, like the what do you call it, the SDI movement. So currently there's like some sort of like a shooting star or a graveyard doji kind of formation. Price likely to see some correction, rebound, targeting $12 before rebounding back to $12.76 resistance region. Okay, so next one, I move on to the DBS. DBS is the resistance level has been tested multiple times. Breaks up, I think I shared on the strategy. I foresee $37 being the new target itself. And then price is likely to either break 36 and then followed by a rebound back to 35 and then targeting 37. So the unknown is still on there. Okay, you can see that ADX is still on a very high, with the DM plus still remaining very high on the site itself. Okay, so for UOB, you can see that price actually had a gap up today. It has already surpassed $30, close above $30, but this proven to be perhaps an island reversal or a long leg doji. So any case, the evening star last week was invalidated and then was confirmed by the bullish Marubozu on this day. So looking at the chart, right now we are approaching the target new high. So expect some sort of like maybe some sort of like a light correction before going up to the upside. So if there is a light correction, $29.35 to $29 will likely be a place of a potential rebound to the upside once again. For SGX, the breakout based on my report has been strong. Price has tested the $9.65 to $9.75 region. Region has been tested. So expect some sort of like maybe a slight correction despite breaking above Ichimoku Kumo and the Tenkan-sen and Kijun-sen. So likely price will revert back to $9.34 before rebound to the upside once again. Among all the property counters compared to like CapitaLand, then the REITs like Ascendas, all these are on the downtrend. Fraser Centrepoint is also on the down, is much more on a ranging kind of like trend with no significant strong movement. However, if you look at city development, I think most of you have asked. You can see that the inverted head and shoulder is still ongoing. Price has already broken out of the, has already filled out a gap. Prices is now testing the resistance zone at $7 and 12 cents to $7.21 region. So this may be a harami. If there's harami, then there will be like a kind of like a consolidation. With price reverting back to $6.92 before rebound to the upside once again. Okay, so now I'm moving on to Hong Kong counters. Sinok last week has gapped up, but price is facing some of consolidation. You can see that the DM minus like what I shared on SGX early on. Not SGX. I think yes, on UOB. Kind of like a same kind of like a movement between ADX and RSI, oversold, extremely oversold above the 80 line, and then this like there may be a consolidation over here. The resistance remain at $9.31, so expect some sort like of unknown, but you can see that this is really clearly a runaway gap, strong gap up, but you know, if there is a fill out gap, then this may be island reversal. But judging from the momentum right now, we could see a consolidation before breaking up to target $10.03 for now. JD.com prices still, I still remain my target at 315 to 324 region, forming a double bottom at a major support zone between 247 to 254.8. If this one is an inside bar, expect some sort of like clearance above the key clue is above, expect some sort of clearance between above 286 region, and then a break, and then to target 315 to 324 in the near future. Hang Seng Tech, you can see that there is some sort of like inverted head and shoulder. We are expecting some sort of break above 0.987 to 1.02. And then there's some sort of like a falling wedge kind of pattern that a small wedge actually like has been confirmed. So hence we expect some sort of like a break above, but the break we may be targeting like 1.07. So do take note that the downtrend is still ongoing quite pretty intense and strong. Moving back to Singapore Mapletree Industrial Trust, like Mapletree Lock, downtrend is still on as displayed by Ichimoku with the recent bearish Kumo twist. The thinning of the Kumo suggests that despite being on the downside, we are experiencing weaker momentum. $2.55 is still my rebound area. So yeah, do take note of this level. Yuan Kuang is some sort of my report. So do my report on that. Price has already broken out of the bullish flag. There are some sort of pullback and then testing of the Tenkan Sen and the lower level of the support of the flag. So hence we may expect $18 to be onto the upside once again. AEM range bound after breaking out of the diamond top, despite a bullish engulfing. $5.31 resistance level is still remaining untouched, unbroken, with a dark cloud cover followed by consolidation. So we expecting some sort of range bound. Preferably, likely there will be some sort of like retracement back to $4.80 before a rebound to the upside. Target $5.31 to $5.40 again. This will likely to be taking some time. Maybe on the near end of the first quarter. Capricorn upside rebound was quite strong. You can see that $5.10 support region and $5.17 support region was quite tested quite a number of times. Prices rebounded, Morningstar, and then but price has a clear major resistance at $5.30, shooting star potentially. So if this happen, then we might see Capital prices pushing down lower for Capricorn. For CapitaLand Invest, then you can see that price actually has a double bottom kind of formation at $1.91 to $1.95 going forward, and then prices overall on the larger structure it remain range bound. No significant clear upside target to be seen. Unless you are seeing a break above 2109, then we could see a confirmation of the double bottom. So lastly, we have come to Thai Bev. Thai Bev is kind of like a consolidation. Despite rebounding on the support zone on the 2nd of December, prices is not really responding well. Prices is still hovering. So there might be two outcome. This kind of falling wedge may be broken on upside, but judging from momentum itself, with the DMI, the directional movement index having a crossover, so signify a very range bound market. Ichimoku is showing a downtrend, so hence we are not really very strong on Thai Bev itself. All right, so for the rest of counters that are not being covered, they are either range bound or no clear signal. And there's particular one counter. Okay, let's see Wilmar before I forgot about this. So Wilmar, you can see that it's like what do you call it? Capricorn support zone between this level 412 to 429 has been tested, and then inverted head and shoulder. So this is a rounding bottom. So this may be a smaller cup and handle kind of formation, but chances are $4.18 must be supported in order to confirm the potential inverted cup and handle. So if this is really a clear signal, let's hypothetically say that the cup and handle is being formed and then being targeted, the next target is will really like 462, 471, and then after that there will be risk of selling down again. All right, so yeah, that's all for me. And then Sheng Siong straight trading, especially Sheng Siong, just don't look at it for now. All right, because it's really trading on a range bound, and as well as straight trading, no momentum, no volume. All right, so with that, I pass on my time to my colleagues for the next session. Thank you.
Natalie
Viren.
and Glenn.
Thanks, Viren. I'll take the first question. Okay. Sorry, the first question I saw was, why are logistic REITs such as Mapletree, Ascendas, etc. price dropping when many analysts think that this is a good sector to be in with new trends like e-commerce, data centers, etc. So I think overall, just from a macro view, the S-REITs have fallen by about by about 2.5 to 5% since the start of the year. And I think that this is in anticipation of rising short-term rates. So historically, share prices tend to react before the interest rate moves. Which is right now. We are anticipating the short-term rates to go up, but it hasn't yet moved. But prices are reacting in advance. And for these counters like Mapletree and Ascendas, you are right. The new economy sector is one of the reasons why analysts like this the industrial subsector. Of course, they have also been relatively resilient with early price recovery. And that has helped with their acquisitions. But one of the reasons why the price could be more amplified for these counters is because it could be due to rebalancing by funds. Because do recall that in 2021, because of major acquisitions, there was actually at least 2 rounds of fundraising by Mapletree and Ascendas. So this could just be the larger movement in prices could also be due to rebalancing. Yeah. Okay, I hope I answered that question. Let me scroll through the questions. Second question, will demand for office grade A and grade D be increased this year? So for grade A, we are actually seeing a flight to quality. So that means during this tenant favorable market, and while, yes, there might still be some downsizing, or when tenants relocate, they might still reduce their space needs slightly. However, this is a good time for companies that are in it for the long haul to actually upgrade their corporate offices and move to better locations, better buildings, and that's why we are seeing a flight to quality. So in terms of grade A office, I think overall the office market, there's a slightly elevated vacancy. It used to be around about 5%. I think now it's around 7%. And so right now we have a slightly elevated vacancy. And also not to mention, there will be some supply that is pushed in, that was supposed to come on earlier in 2021, but has been pushed back. So in the next 3 years, there will be a little bit more supply. So that's why we are a bit more cautious on the office subsector. We think that it will still take some time for the supply to be absorbed before we can see stronger price increase. Yep. There's another question here. Please advise on the outcome of the shareholder meeting for the ARA Logos in view of the ESR merger. So basically the EGMs or the AGMs that have taken place, these are mostly like shareholder meetings, and to explain the merits of the merger. So there actually isn't any outcome or any conclusion. Overall, the EGM where unit holders such as yourself will actually need to vote will happen sometime around May. Yeah, and not to worry, we will be hosting ESR as well as ARA Logos, or rather we already have hosted them. Yeah, so it has not yet concluded. Yeah. Okay. Okay, sorry, I forgot to turn on my camera. Okay. Let me just scroll through the list. Another question is, how do you think S-REITs will perform this year generally with the expected hike in interest rates? Overall, in times of higher interest rate, in a high interest rate environment, the S-REIT tends to underperform the STI. But of course, that being said, 2021 was a year of acquisitions for the S-REITs, and we do expect recovery, especially for some of the counters that have been lagging, such as your retail, hospitality, and office. These counters have been the share prices have been lagging the general recovery of your industrial as well as your healthcare, and they will benefit from the further reopening. So I think there's a little bit of catch up here, so the acquisitions will help to grow DPU as well as the recovery in general operations. So overall, REITs are still, we still think that we can consider looking at REITs because they are still relatively fairly valued. And that being said, we also do expect that acquisitions will continue despite the despite the gradual increasing of interest rates. Interest rates still remain below historical levels, and it still presents a little bit of a runway for acquisitions before the interest rates actually cross back up to historical levels. I think I'll pass the time to Glenn for now.
Thanks, Natalie. So I'll just touch on a few questions about, the first one would being the outlook of OCBC. I'll just briefly go on about OCBC. So OCBC is actually lagging behind DBS and UOB, and this is seen more evidently from their PB ratio. So they're quite far behind. And I think there's three main reasons why this is so. So firstly, their NPAs actually went up quite significantly, and this is due to Malaysia. And secondly would be their NIMs. Their NIMs were the biggest hit compared to the other two banks. So let me just bring up my figures. So give me a minute. So the NIMs actually fell 6 basis points for third quarter 2021 to 1.52%. So this affected them quite badly compared to the other two banks. And lastly, they also have more wealth management and their insurance line arm as well, and less NIM related sort of income compared to the other two banks. So they would actually reap less benefits to the higher interest rates, which have already been sort of expected by everyone. Okay, so however, OCBC would eventually catch up, as in to the average of DBS, all the three local banks. However, I'm working on some charts now, and I think I will show it soon. So the next question being regarding the UOB's acquisitions. What is, with the acquisition of the Citibank branches and using up its excess capital, what are the chances for a special dividend to be paid out for FY 2021? So they have, I would say that they have used the excess capital to buy this Citibank branches in the 4 countries. And I would say the special dividend, the chances would be slightly lower, as they have used about 5 billion for this. So it's slightly lower, I would say. And how does excess, I think it's linked to the first question about the UOB, how does excess capital volume affect the dividend payout ratio, if there is any effect? And there's no direct correlation, I guess, if you think about the numbers, but if you look at it, of course, if the excess capital which they have used to pay for this Citibank acquisition has gone down, so the dividend payout ratio technically would be lower, but UOB management has come out and specifically said that they would be maintaining their 50% dividend payout ratio. So I guess there's no effect in it lowering. Lastly, also regarding the UOB's acquisition, is your target price of $31.30 for UOB inclusive of the better performance brought about by the acquisition of Citigroup business? If not, how much upside in the target share price could we expect after the acquisition? So I think I've mentioned in my the brief details about this UOB acquisition that the completion is only expected between mid-2022 and early 2024. So now they are just still going through all the paperwork to get it done. So it's only the announcement that has been made. So my target price was, because we raised the FY21 earnings by 3.8% because we increased our NIM estimates for FY21E, as previously our NIM estimates were very modest. So now we assume 1.26 times FY21 price to book in our GGM valuation, up from 1.17 as we raise our ROE estimates to 10.2%. So I guess this is more of a medium to long-term sort of goal for UOB, for them to accelerate its growth in the ASEAN, especially in these 4 countries, which they already do have presence in. Let's see, what else do we have? Okay, I think there's one about iFAST. However, sorry, we don't cover iFAST, so I can't. They asked about the target price for iFAST, so I can't comment on what target price for iFAST, as we don't cover it. Okay, sorry, what is your revised UOB target price following the acquisition? Okay, so it's not really following the acquisition per se, but yeah, I mean, it comes. Our target price now is $31.30, and this is up from $29 previously. Let's look through quickly. Okay, I think I've answered all the questions regarding the banks. I'll hand over to my colleagues, maybe Paul.
Okay, thanks. Thanks, Glenn. Let us just try to take some of the questions. Can you share insight on the oil and gas outlook in 2022? Are the high prices sustainable for the year? Terence covers oil and gas marine sector, but let me just share whatever we can. We think oil and gas, we think oil prices, there's still room for it to rally. If you look at it, it's probably going to be one of the later cyclicals. The oil price is already high, even though transportation sector hasn't kind of resumed to norm. So if things normalize, activities normalize, then you're going to get this big, huge surge in demand for transport fuel. No gasoline, we know, diesel for trucks, and then jet fuel. So the demand for these 3 sectors hasn't even resumed to norm, and oil prices have already hit their I don't know, it's like close about $80-90. So if the resumption, if developed countries reopen and everything is back to the norm, I think the demand could surge. That's number one. Supply hasn't responded. I think the Russians couldn't respond. And if you look at the US production numbers, which is essentially shale, from pre-pandemic levels to now, they're actually down 11%. I mean, when prices are high, you can believe me, they will all want to respond. But I think they've been focused more on repairing balance sheet, repaying dividends. They've been a bit more careful in their capex. And shale is, very capex heavy. So the supply hasn't responded. So the demand supply situation looks good. Only thing near term is just whether China is a big part of the demand, and with the pandemic, we just not clear with it. But the outlook for oil prices look good because the big spike in demand hasn't occurred yet, but the prices are still so retrending so high. So it shows that there's a big demand supply mismatch. Yeah. Again, this is just our views. We don't really. Terence would have the more that covers marine will give you a better answer. For telco, even though the mobile plan and roaming is reducing, the data plan is ever increasing. Yeah, I think that's the point. Whenever we go to all these telco briefings, we always ask them, has 5G made any impact? So far, it's been very modest. Only people who use 5G is probably the mobile. I don't know, 5G probably make your YouTube faster by maybe 1 second or 2 seconds. I'm just kidding about it. It doesn't really have much impact. So far, 5G has only been for mobile and entertainment. And the other problem is also competition. I'm also trying to get a plan because TPG now has $10 for 100 gig. And so whatever increase in data is just going to be competed away. So that's the other worry we have. The demand is not responding to 5G, and also there's so much competition now. And this is only TPG, not having about Circle Life and the rest. Okay, I hope that answers. Terence is not here, but if you send an email to him, maybe he can help you on the BRC question. Next one, can you enlighten about the ComfortDelGro since it collapsed so much? Bad news. I think the biggest bad news for me, 2021, biggest surprise since the call wasn't good. It was down 16%. Was mainly the taxi rebates. We thought the taxi rebates which was in 2020 was as high as 50-75%. We thought the rebates would disappear. 2020 the rebates was almost 100%. We thought the rebates would disappear this year, but it didn't. It still persists to, 20 to 50%, depending on which quarter. They don't actually give very detailed numbers, but they just got like 20-50%. So that was the biggest disappointment, and that was the one that caused the weakness. And of course, you saw sorry to drag on, but the restructuring also, there was also this issue with the bus restructuring. So it didn't really pan out as we expected. I think you can get it from some of the reports. Yeah, so that's one of the reasons why it kind of underperformed last year. I think this one is CD. I'm not sure if you answered it, Natalie, but let me just move on to the next one. Will the transport fee increase due to inflation? If so, the profit may be affected. Yeah, the transport fee, okay, this is not very transparent per se. The Public Transport Council will raise, but they never raise to the full. I think if they wanted to raise, the media said that our fees should be up 50% instead of 2%. So I think this year, our fares are only up 3 cents or 4 cents if you exceed 14 kilometers or something along those lines. If they really wanted to raise, it should be 50. But at the same time, behind the scenes, the government is also subsidizing. So it's not particularly clear. But for the bus, higher fuel prices will benefit SBS Transit. Again, the issue we have is because these are all I don't know, official secrecy and whatsoever. They don't share with us because this is the government. This agreement they signed, but they do mention that there is a fuel indexation. So there is some spread, some income generated when fuel prices are higher. But again, they don't give exact numbers. Yeah, but actually, higher fuel price ironically does benefit them on the bus side. Okay, I'll answer this before I move on to okay, there's just two more, the SPAC and palm oil. Okay, can I know why high palm oil price does not bring up Wilmar stock price at all? Instead, it went to historical low. Yeah, actually, the interesting thing is that it didn't even move Golden Agri, because Golden Agri is even purer play, because Wilmar has consumer business in China and also Indonesia, and Golden Agri is a pure plantation. That means they benefit the most when high oil price. Our view is that there's a bit of derating in the valuations of palm oil. We mentioned it, I think maybe last week or the week before. The reason is because a lot of funds now don't buy into palm oil because of the ESG issue. The only people buying are probably the Malaysian funds that buy in Malaysia. So maybe Malaysian valuations are very high because the local funds will buy. But the European funds won't touch this. And I think as the ESG continues, we worry that the palm oil stocks will continue to derate because the institutions won't buy this, which you rightly mentioned. I mean, this is a record high oil price. Of course, the other reason is maybe people do not think this is sustainable this is purely because of the shortage of workers tapping palm oil. You know, palm oil is very labor intensive. Yeah, if you ever tried, it's like I don't know how many foot pole that you have to harvest the palm oil. Okay, so okay. Let me move on to the last one before I move on to I think a lot of it to Natalie. Okay, what's your take on SPAC IPO? Can you comment on the upcoming SPAC? We did a report on SPAC recently. So our view is that there's a pre and post IPO. So pre IPO, apply as much as you can. I mean, you can like. I would also be queuing at the ATM to go and apply because it's a free lunch we call it a free lunch because the IPO is $5 and your $5 is cash protected. You will get back your money if you don't vote, if after 2 years. And at the same time, if you're an IPO investor, if you're lucky enough, you will get the warrants 0.5 to 0.3 to 0.5 free warrants. This is free. Of course, the problem is the retail tranche is only, I don't know, 2% of the total. I think some of it is only 600,000 lots is only available for public. The rest is for private banking clients and institutional funds. So we hope this is not like a compensation scheme. But anyway, at IPO, definitely apply as much as you can. Post-IPO, be a bit more careful once it's listed because you're going in blindfolded. You do not know your target company. You do not know the valuations. You do not know when the target company, how much vendor shares is coming, what is the cost of the vendor shares. So, I mean, unless you like blindfold, I'm sorry, I'm just kidding, but I wouldn't, you can pay a slight premium, but just be a bit more cautious post-IPO. Okay, I'm not sure if we have got any more time. Natalie, you want to try some?
Okay. I'll take the question on what will be the impact on the recent property cooling measures on CDL. Okay, so as I mentioned earlier, the two cooling measures, one of them was the raising of the development charge, which is the charge that is incurred by all the property developers when they choose to redevelop a piece of land. So that is the development charge. It varies based on location, based on where the property is located, or rather where the upcoming project is located. So this developmental charge will vary. Then for the second cooling measure, that was the raising of the ABSD, that will affect mainly second property purchases onwards. So that means if you're buying multiple properties, or this is not your first property, that is when the ABSD will affect. That being said, we think that the cooling measures will likely sort of temper down demand transaction, especially because of more of a wait and see approach. This is of course in conjunction with the record high property prices. Yeah. For CDL, we think that the inventory risk is low, which I mentioned earlier, because of the kind of inventory that they currently own. Most of it is actually those that have not yet been launched. Most of it is 24% is actually ECs, and as you know, ECs they are launched. All of the units are launched at one go, and they usually achieve a relatively high take-up rate in the initial 1 month. They can reach up to like 70-80% sold. So EC, there's no concern there, and 24% of the stock is actually from ECs. Then another 26% is actually in mass market kind of condominiums located in the OCR, where we think that there might still be some demand from upgraders as looking at these kind of properties as as an upgrade from be it HDB, or maybe they were once taking smaller units, and now because of work from home trends, they require larger units. So we think that there's still some demand for OCR. And when we look at the remaining of their stock, the 40% that is remaining, 35% actually comes from the redevelopment projects, which are Canning Hill Pierce, located in Clarke Quay, as well as Fuji Xerox, which has not been launched. So if you look at Canning Hill Pierce, they launched Canning Hill Pierce in November, early November, and currently about 80% has already been sold. Yeah, so there's actually, in our view, for CDL, there's actually quite a relatively low inventory risk. Yeah, and that being said, when we spoke to CDL, we asked them, will you ever stay out of the Singapore market given the rising land prices, etc. And I think their stance is that they are property players and they are property company. They will always be bidding and taking part in residential builds. And that being said, they will always go in with their eyes open, meaning to say that even with the higher development charges and rising construction costs, if they were to bid on a project, they will make sure they work out their numbers before. Yeah. So I think overall, their current stock, the current inventory, we do not see an inventory risk. And moving forward, based on their track record, any future, new builds or new projects that they take on would likely be they will likely have their numbers worked out. Okay. Can you comment on both Prime US as well as Manulife? Okay, so for Prime, we have had a preference for Prime US REIT, and this is because of the kind of tenants that they have in their portfolio. So a lot of their tenants are they have a higher percentage of tenants that are in the new economy sectors, such as your tech companies, your life sciences companies. That forms about maybe 35% of their tenant mix, as compared to Manulife, which has only about 17%, 15% of tenants that are in these new economy, bioscience, life science, technology kind of companies. And the reason why these kind of new economy sectors are important is because they are currently enjoying secular growth, expansion, and growth in revenue. So this allows them to expand, and command and afford, so to speak, higher rents. So this is where we expect most of the rental growth to come from, in comparison to your traditional office users like your finance for companies, your banks, your legal firms that might still be actually rationalizing their space needs. Yeah. Okay. So overall, that being said, do recall that actually Manulife has recently made 2 acquisitions into the Sunbelt region, more of your gateway cities, your growth, not gateway cities, sorry, your Sunbelt region, which is more of your growth cities, and that comes with a slightly higher NPI yield, and of course that will also help with the DPU growth. And in terms of from a valuation point of view, if we are looking at the valuations, so Manulife currently is trading at around 0.67 times price to NAV, compared to Prime, which is currently trading at around 0.84 times. So from a valuation point of view, the one with the greater upside, of course, would be Manulife. And that being said, we do have accumulate call on both these counters. Just that presently, because of the way the share prices have moved, Manulife is showing a higher total return. What is your target price and outlook for CICT? So for this question, CICT, they also recently in December announced that they will be acquiring, or they will be they're actually planting a flag in Australia. So they have acquired 2 office assets in Sydney, and overall, we haven't moved our target price yet to factor in this acquisition. In terms of outlook, based on we are seeing that tenant sentiment has improved, but then because we don't really have much visibility on the 4Q performance as of yet, given that they haven't announced. But we do expect that by the time 4Q hit, we know that we entered transition phase, and so that of course would make leasing and viewing of space easier for CICT, and we think that will have helped with the leasing demand for CICT. That being said, the catalyst for CICT will of course be the return to office, which will not only bring back more of the tenants, but also help with the suburban mall recovery. Yeah. Okay, I think that's about it. The target price for CIT currently still stands at $2.54. We have an accumulate rating.
Okay. Thanks. I think we have to rush. We have to go because Viren has another event later on. But do remember for next 3 days, we do have listed company presentations. GSS Energy, TOTM, and also IX Biopharma on Thursday. So if you have time, feel free to register for them. In the meantime, wish everyone have a great week ahead, and thank you so much for your questions and for all your time today. Thanks everyone. Take care. Bye.